All right, today's Outlook video is a unique tale of two different tapes. First of all, we're going to talk about how the market reacted and closed today. Might not have been as bearish as you thought it was, and we'll take a look at why and whether or not what were the odds that we would break below these lows. That this is our third attempt at versus bouncing off of it and moving to the upside. But then, after the futures market closed here, while we were preparing the video, there were some tweets about tariffs. The U.S. ratcheting up their tariffs on China in retaliation for their retaliation. So we're going to break that down, what that might mean, and what we might expect, and how that can impact our posture, and then how we can trade for that. And fortunately, we already did a trade for that in our Market Outlook Live at 3:30 p.m. Not knowing, of course, that was going to happen, but it turned out to be fortuitous for us. We'll break that down and what kind of trade that was in today's trade idea. So let's go ahead and get started. Today is Friday, August the 23rd, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, as always, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see, obviously, the selling that we had throughout the day today. Of course, in the right after the futures closed, we had new tweets about new tariffs and strengthened tariffs and delayed tariffs are now not going to be delayed, and all those things coming out going to impact a lot of this by the time we're all said and done. But we'll go ahead and just take a look at the chart as we close, with a nod towards what these tweets can do over the weekend, considering we haven't seen what the futures market has done with them yet. So we closed down, obviously, at the low of the day, pretty much near the low of the day. You notice again, so the red line here, if this is an intermediate pullback, or excuse me, a long-term market sentiment pullback where the orange line eventually drops below 50, then you can see as of right now, we're still right around the red line. The red line is a 23% Fibonacci retracement. The blue lines are the current intermediate pullback that we're on. That's the intermediate rally we've had, and so far we've pulled back again to the 62% Fibonacci retracement. All three times to get here were all three big down days, and they were all followed up by bounces off at these levels. So every single time we went from the high of this range to this point in one single day. So there's a pattern for this. Now, the last two times, you can see the momentum line here came to extreme lows. The near-term line was oversold. Over here, the near-term line was oversold, and the momentum line was somewhat so about where we're at right now. The difference here is the near-term line's not down below into the lower reversal zone. So a little bit of a difference there that we had. Even though we were actually a little bit more bearish, and we were more bearish over here heading into it, and here we dropped all the way down there with those couple of days of ups and downs, and obviously we had kind of some ups and downs as well, as even though we pointed slightly higher before this little turn. But again, the near-term line dropping down, not getting into the reversal zone yet, so that's an element to keep in mind. Of course, the intermediate line turned down. We're back to this bearish pattern of dark pink shading, red line, right? That's the bearish combination here on this chart. The bullish combination obviously is the opposite, green line with dark green shading in the background. Any other combination can be seen as an opportunity for a reversal, right? So anytime you have light green shading and a yellow line, that can be a selling opportunity. Anytime you have light pink shading and a yellow line, that can be seen as a buying opportunity. We actually didn't get either one of those here. We did get some light green shading. This is the only time that we've had the green line or yellow line as well, even though this case it wasn't the yellow line because we closed above it, which is usually the case, right? Over here you see how we closed below it. That's what caused the yellow line. Here we were already below it. The moving average moved up temporarily. Just one day it moved up before falling back down the next day and turning red again. So we continue to have that bearish combination. The intermediate line or at least flip-flopping between strongly bearish and really not getting the selling opportunity pattern where you get the, like I said, the yellow line and the light green shading. Now, of course, you get, yellow line and light green shading, and sometimes that's your reversal pattern. Over here, yellow line, light green shading. That ended up, moving over to the reversal pattern. So they're not all selling opportunities. They can eventually turn into dark green shading and a red and a green line, right, which is your bullish combination. So these two intermediate runs. So we'll see what happens here with the S&P sitting at support. Of course, you look at the Dow Jones Industrial Average, same pattern, still hasn't broken through those lows yet. The Nasdaq Composite, same pattern, almost the same exact pattern, and then the Russell 2000, you can see, also not quite getting there. Remember, it had an oversold cluster over here. And again, its near-term line didn't drop in the reversal zone, and momentum line was relatively lower. But again, same pattern, dark pink shading, red line. So we're getting some bearish patterns across the board here. Since we are at the end of the week, we'll take a quick look at the weekly chart. Remember, next week will be the monthly candle. So we'll take a look at the monthly market forecast after the end of next week. But if you look at this, again, kind of a similar idea. You have a light pink shading and a yellow line. That ends up being a buying opportunity. Light pink shading and a yellow line ends up being a buying opportunity. Now it can turn around like it did here. But you can see even on these long-term charts, light pink shading, yellow line ends up being buying opportunity. Well, the moving average is rising, and we close this week below it, which means next week's line will be yellow, and we have light pink shading for that. So can this be a buying opportunity on this weekly chart, similar to what we've seen in the past? And we have a weak bearish posture. That is something to keep in mind. Some of these others we didn't quite have. We had a weak bearish posture over there, I guess, as well. And even on this one, we had a weak bearish posture. And over here, we had a weak bearish posture on this kind of long-term chart. Over here, we had the weakest, at the end of 2018. So we do have a weak bearish posture again, not as bearish, not as weak as we've seen previously. So again, in the past precedent, that sets up for, a buying opportunity, and we'll see if that support holds and turns out to be the case or not. All right, as always, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. Also, it's also down below the video. That will notify you when these videos are posted. Hit the thumbs up icon down below the video too. That tells us two things. Number one, you got something out of our video today. You liked it. Number two, you want us to do it again Monday. So if that's the case, the only way we know after you watching the video, because we can see the views we get, but the only way we know you want us to keep doing it is hit that thumbs up. That's an easy way for us to get feedback from you with one click. Also, while you're down there, comment, what did you get out of the video today? Let us know there. Join our Daily Market Outlook email list. There's a link popping out top right corner of your screen. Click up on that link to subscribe. Follow me on Twitter for more content in between the videos from day to day. And join our Market Outlook community that we've created on Facebook. All right, if you're watching our Market Outlook video on our blog, keep in mind something that came out here while I was prepping the video is Brandon released his sector selector tool for this week. That is one of the tools for our premium subscribers. So for those of you who are our viewers that are subscribers, make sure you check that out. Again, so you can also see we have a Market Outlook live video that goes at 3:30 Eastern time, where we review the old trades from these videos, from these Market Outlooks, and we manage them all the way to their close, keep track of those, as well as we put on today's trade live before the market closes. So we'll talk about what that is here at the end. If you want to get access to that, as well as see an example of our classes, you can sign up for our 7-day free trial by clicking on this link to our monthly plus subscription plan. You can get the information on all of our subscription plans over here on the pricing tab. Finally, we ask that you engage with us on social media. We try to make it really easy for you, and you guys came out in droves, almost doubled from the previous tweet. So I appreciate that. Again, just click on that heart. It opens up a new window and you can like from there. Again, the more you like the stuff we put out on Twitter, the more you like the Market Outlook posts on Facebook, the more Twitter will put our stuff at the top of your timeline. Like as I said before, not everybody who follows me sees my tweets. Not everybody who, even if they're on, right, they will push you the information of the content that you engage with the most. So we try to make that easy for you. All right, so now let's get back to the charts, and we'll look at the weekly chart again, but this time from a Hakinyashi standpoint. Again, most of this range came at the end of the day today. I mean, even as we were talking about in our technical analysis class, we had about a 60-point range as of this morning, and that changed to a 100-point range. Again, similar. We've had now 3 consecutive 100-point ranges on the S&P 500 or more. 161 points over here, 111 up there. So almost a transition candle. Still is a possibility. You can see we're probably going to end up being right around 2,900 is going to be the open, and we're at 2,847. So we're going to open up next week with a bearish candle. But we'll see. We'll see again what shape it takes. This is the third in a row that we have traded around that 200-day moving average, or in this case 40-week exponential moving average. If you look at the regular chart here, let me put this out there, and you can't really see it as well, but you can see. If I were to move my cursor over here, look at over here on the right, you can see the value for the blue line is 28.4968. Well, look at where we closed, 28.4711. So again, we closed just below that 40-week moving average. We've done that before, and we did it right there. And with a gap, when there's been a positive gap in a death cross environment, closed there. Of course, over here, we almost did, and then we really did. We closed significantly below it over here. And then on this pullback, we closed below it. And all of these times, except for, and really we didn't even quite get it over here, just a smidgen up above it. But all the other times we closed below it, we've immediately come right back up and started a new intermediate rally. And we'll see if that ends up being the case again. The case is coming next week, again, in light of the news that came out after the market closed and after the futures markets closed overnight. But you can kind of see the technical environment, and it'll be interesting to see how much of a move there is Sunday night when the futures market opens back up again, and how much of a gap we form. If we gap down with a decent amount of volume, which you would expect that we would, and we don't start to fill in that gap pretty early in the morning, then that's probably going to be your runaway gap where we start a downward move to the downside, since we would be breaking below a significant level with a decent amount of volume. Of course, the assumption being we might fill in the gap in the futures market in the European session. So we'll see how things shake out Sunday night into Monday morning. Let's take a look at the 3 green arrow chart. We obviously have close to 3 red arrows again with the red line, so that would be your bearish combination, almost on the moving average. You can see the stochastics turned down. There's a lot of stocks showing 3 red arrows right now, and after closing above the 17-day moving average 3 of the 4 days this week, we're right back down below the 8-day, and we're pretty significantly below. I mean, we were a lot further below the 8-day over here. And you can see the MACD and stochastics both turned down. Neither one of them pulled below the moving averages quite yet, so keep that in mind. And of course, we haven't broken below support yet either on this. In fact, if you take a look at the Bollinger Bands for SPY, there's your support level. I mean, it's just a little bit below these lows, right about at 280. 280 in this area. That's where your volume node is. That's the biggest volume node behind the one that we've been trying to get through to the upside, and we haven't been able to. So here's the next biggest volume node to the downside. Get through there, and you'll probably have some choppiness down to 275, 274. The bigger break would be below that level. Once you get below that level, there's not very much volume. We went so far down and so fast back up that we didn't get a whole lot of volume down there. It's all been up here in the past year. So, and you can see again with the with the Bollinger Bands relatively wide, we tried to get to the upper half of the bandwidth and really couldn't get there because of that resistance. So we're back into this bearish bandwidth with actually the squeeze still going on. So, again, keep that in mind in terms of how we finish. We might open up below this 278 by Monday morning. So we'll keep our eyes peeled on that. If that's the case, that could be the breakaway gap that you look for more of an extended downside move. In fact, if we take a look at the Ichimoku cloud here, before we go to the intraday charts, where's my, oh, that's right, it's on the styles. So we'll do Ichimoku cloud. You can see, again, the third time in a row we've closed below the cloud during these pullbacks here. So, and you can see this is the 78% Fibonacci retracement of the fan, right? So, here, let me just make sure. Oh, it went all the way up there. There we go. So, it's still holding that area for a support, hasn't broken through that yet. Of course, once you do, then from a timing standpoint, then it makes the run down to 275, where that next layer of support is, a lot more feasible. Haven't done that yet, but getting below the cloud can be a bearish sign, right? Especially when you have your green line here below the blue line, right? That's a bearish combination. We are also way up above the red line over here, which is the red line is the close now, and so you can see we've been on the downward. I mean, that's a bearish combination from a trending standpoint, but we were that way over here. We were that way, not to the same extent, but we were that way on that first pullback too. So this is the third time now that that's been the case, and we'll see if third time's the charm for that to turn into a bearish trend. The third time wasn't the charm to break through that high point, and we'll see if this is the third time is the charm to start again, turn an intermediate pullback into more of a longer term market sentiment pullback. All right, let's see and here's why I don't think that that's the case. Let's take a look at the intraday charts, and you can see, of course, if we pull back down, I mean, that's the all-time high still, but it's going to come off. It's still going to be around there for a few more days. But again, depending upon how far down we pull back, we're probably not going to get down to 272. But if we get to 272, worst case scenario, and we drop down to 272, that will be a 10% width of the 4-week range, and that's usually kind of, again, the rubber band stretched out as far as we can. So keep that level in mind, since we're right around this 302 level, 270 to 272. That would be your 10% pullback of, within a short amount of time, 4 weeks. That's a pretty significant stretching of the rubber band. And you can see the volume. Obviously, the volume and the volatility picked up today. Let's come over here to this chart and take a look at SPY, and you can see the range. The gap was filled in. The early morning gap on the Chinese tariffs were filled in with Chairman Powell's comments. And then, of course, the afterwards, everything that came out later with different proclamations from the administration, first in the afternoon or late morning, and then again right after the futures markets closed. If you take a look at the range today was 929, so more than double the average. And the volume was up to 150 million, so 1.5 times the average. Haven't seen that for a while. Last time was on the last down day like this. Look at the 1 year, it's down to 0.46% to kind of give you an idea on the rate of change, how, for it to get down to that level. So here's the 3-month, which is flirting with the 0 level. And of course, getting below it is when you really get the market sentiment pullbacks. But to give you an idea of, multiply this by 4 and you get 252, right? So this will be the 1 year rate of change on a daily chart. You can see again, the last time, this last little free fall was when the rate of change over the 1 year period dropped below 0, right? It really started to free fall from there. So this is how, that was the last time too that we really had some scares on the tariff front, on the Chinese tariff front. Back in October, right before the election, the rate of change also got down below 0. very briefly before starting a really good rally where the 1-year returns got up. Let me give you some more perspective on that 1-year rate of change. So of course, when you broke below, you got down here on one fell swoop at the end August of 15, and that bounced off of it. And then getting below zero on early 16 really had a pretty significant decline before getting down to about the same level on a 1-year basis as you saw at the end of December, and that set the low point. All these other times you can see, you can briefly get to just below zero. In this case, in August 2011, that's how bad it was, but it got to briefly below zero before it set the low point. And same thing here in May of 2012. The 1-year returns briefly got to zero before setting the low point. So, we got a situation here. I mean, this will either set the low point and we'll bounce off of this. And keep in mind what it looked like 1 year ago. So August, where is it? Where is August 2018 is right here. Right, so the 1-year return, unless we go up by this amount for the next 2 months, almost month and a half, the 1-year return is going to get pretty negative. So we're either going to set the low point here and bounce up to a similar amount according to past precedent, or we're going to, it's already going to go down even if we were flat for the next month and a half. If we were flat, the 1-year return's already going to go down below zero. And if we break, then we will look for it to get to that double-digit low point and see if that's where it eventually sets the low point and any surge in volatility. Will that happen? Well, according to the volatility market, probably not. Right? I mean, again, this is before the Trump tweets on the new additional tariffs after the futures market closed, including the volatility futures. You can see heading into today, we were at the high of the day. We got above 20. But we did not get above 105%, which is the extreme. We didn't get above 115%, which tells us we're headed towards a long-term market sentiment pullback. We still haven't done that. Now, we could on Monday. So we'll watch and see what happens on Monday. But to kind of give you an idea of how we finished today, we closed near the high of the day, which is not too common. Usually the volatility goes down throughout the day, not up. And when we have closed at the high of the day, you can see we've done it 4 times here. A couple of times kind of back to back. But if you look at each time, from this point to this point to this point, the highs have been progressively lower. In fact, we closed at 2050 after hours, and before the market closed, we closed at 1987. And you see that, again, we were below the 1 mark here, flirting with the high there at 2107, got up to 1. So, and you can see how we were above 105, we were extreme. On this level, we got almost 105, and here we barely got to 1. So you can see that volatility on each successive day that we've closed at the high has closed at a progressively lower high. Again, so if barring those tweets and how the market might respond to that, and anything that may happen over the weekend, right? Because, of course, any tweet or announcement can come out on Sunday night, Monday morning over in Asia, and really kind of get things going again in the futures Sunday night. So depending upon how that reacts, we went into the close on Friday with pretty much, a pretty decent opportunity for us to bounce off of those lows according to what the volatility and other technical charts are telling us. So whether that ends up happening or not, of course, remains to be seen. And will we get that gap, right? That gap below on Monday, and that's kind of what I'll be watching for. Just like I was watching for any kind of gap through this level with a decent amount of volume to be the kind of like that breakaway gap to the upside. The same thing could occur to the downside. If we get a significant gap here below this 280, 278 area, and we make a run with a significant amount of volume, which obviously probably would have, that could be your breakaway gap that doesn't get filled, right? Breakaway gaps don't get filled. That's how you know that this trend's taken off. There was a possibility that this one was, and it got filled about a week later. All these gaps have been getting filled. Even this morning's closing gap got filled. So the common gaps all get filled within a short amount of time, and it took about a week, but within a short amount of time. The question now is, will we get one through a significant level, price level, with a bump in volume, and those gaps don't get filled for a while, for a long while. It could be months, it could be a couple years, but it could be months, weeks to months before it ever gets filled again. And that's the scenario heading. That's the scenario that we have going into next Monday morning. So sorry, I forgot you can't see the chart here, but that's kind of the idea. And if that occurs, then we'll adjust our portfolios. Heading into the close, the likelihood of that happening was very low. Coming out of the close, there's a chance. There's a pretty decent chance. So let's keep our eyes open Sunday night. See how that gap forms Sunday night, because it most likely will in the futures market, but that's always very light volume. So let's see what happens, throughout the rest of that Asian European session until Monday morning, and then when the volume picks it up, do we start filling in the gap? If we do, great. If we don't, then we know things have changed. So what do you think? Do you agree or disagree with that assessment? There's a link up there, top right corner of your screen. Click on that link. If you agree, hit agree, of course. If you disagree, click on that button and then comment down below on what you're seeing in the charts or indicators or whatever that would suggest that there's a pretty decent likelihood, even before these Trump tweets, that we would break down to the downside. Or maybe despite the tweets, you think there's probably still a really good chance that we go up to the upside. So let me know down there in the comment section below with what you're seeing. All right, so not surprising, by the end of the week, you can see how crude oil went from almost a 4% gain for the week all the way down to a 2.5% loss before coming off of its lows at the end of the day. The stock market was down almost 1.5% again going into the close. Things might change afterwards. Interestingly enough, we did have the safe haven assets outperform, but they didn't really gain very strongly. Again, that's a function of gold and long-term bonds already being so overbought. So it's going to not be impossible, because nothing ever is in technical analysis. But again, the reward to risk for bonds that are already up here, getting back to above the 1 standard deviation on the 1-year chart, and of course, above the 2nd standard deviation again on the 5-year chart. And then gold, and you can see the big amounts of volume you have down there. And then gold again closing outside a 3rd standard deviation and 4th up to the top side. That's continues to be a significant move and limits the upside returns from here, right? It doesn't mean that we can't go up, especially in the short term, because you can get really significant parabolic moves in the short term. But the intermediate to long-term returns from a point like this you would expect would be lower because of how overbought we are to get to this point. So that's what we're seeing right now. I mean, that's the function that we see. Interestingly enough, before this tweet storm on before the tweet storm that occurred here over in the afternoon, the dollar really dropped back down. So it dropped back below 98 again, down to 97. Now the question is going to be, is that going to hold, right? What's the dollar? How's the dollar going to respond heading into that? Because that was a significant pullback in the dollar after failing yet again at that $98 level. And of course, you can see with the move that we had today. And if I were to look at the intraday chart for the dollar, let's see here. Let's make it easier for you to see. So if I take a look at the intraday chart here for the dollar, you can see this is what it looked like throughout the day today. We came all the way down to about this 96.5. Most of it right initially when the protectionist tweets came out. And then we finished, even though the market closed at a low point, the dollar kind of held a little bit of a downward bias. And then this is how it responded. And again, keep in mind, 0.5 to 0.2 or 0.6 to 0.2. When you consider that we had a range here from 97.6 up to 98.6 on 98.5 on an intraday basis, a whole point there. Then we had about a third of a point decline initially. So now we'll see how the dollar responds again to this news of tariffs. Additional tariffs, and how that can respond. Now again, that what we're seeing, what it has the potential of doing is impacting the yield again. So that long-term bond finishing where it's at. Here's the chart for yield, and it continues to be just extremely bearish to the downside. Here's the let's go back 20 years, and then let's get rid of the colors at the top to make the chart easier to see, and then let's come down here and let's set this line to the current level, which is at 18,24292. 18,24292. So that's where we're at, to kind of give you an idea again of how we've been this low before in the 2011 credit crisis, and we actually went lower again and had this tremendous divergence in 2012 before we rallied 100%, where the yield doubled from 1.5 up to 3% by the end of 2013 with QE3. QE3 really took off there, and then it started to tighten and eventually came off the table at the end of 2014 is when it eventually ended. If you take a look at 2008, the credit crisis, again, we didn't fall. We went from 4% down to 2%, so we just about lost about half of its value during that time frame in this short amount of time. And you can see that we basically doubled. Within a year plus, the yield doubled back to the upside, and that was with QE1 that led most of that. QE2 led that rally, and this was the QE3 rally. This was the Trump election rally, and of course, initially, you can see kind of trade issues, but look at that. I mean, sharp decline. It's not unprecedented, but in fact, it's not, especially not unprecedented in the recent period, and it's hard to go. You can't really go back too far and see anything to the same level even before this when you look at other charts. So this is a significant decline, and we've had 3 of them: credit, the financial crisis, the credit downgrade, and then now this trade issues, and all 3 of those, short amount of time with one divergence, ended up setting the low point and then the yields doubled from there. So we'll see if that ends up being the case this go around. Obviously, the Fed funds futures also it looks like they have a little bit of trading here, but you can see that the odds of not getting a rate cut, which were up to 10% after these kind of relatively hawkish comments from some of the Fed speakers, dropped back to 0, back to 95%. By the end of December, we have a 0% chance of one. We actually have an 80% chance of getting a second. So it's not, it was 79%, but it's not like 100. Like that number is really fluctuated. It actually fluctuated all the way down to single digits today even. So pretty decent, pretty decent odds we get that second one, but it bounced right back up here late to 21%. So interesting to see that development there, especially on an intraday basis. Of course, going out to April, which is 6 meetings away, 100% chance we'll get at least one, 95% chance we'll get a second one, 75% chance that we'd get a third one. So that's not really baked in the cake either. And then you add up all of these, 58, 62. So you're getting less than a 40% chance that we'd get more than 3 by April. So that's 3 in 6 meetings. It's not exactly like a steady spate of rate cuts. The markets, at least it would have like a fourth one 60% priced in, and it's not even 40% priced in for a fourth cut going out 6 meetings. So it kind of just shows that the market's still expecting more of a mid-cycle adjustment here. Again, going into the close, we'll see how the futures respond once they're able to price in the impact of what happened here in the afternoon, and especially, and potentially what could happen over the weekend if there's any kind of response from overseas. All right, so as I mentioned before, the sector selector has been updated for this weekend. So make sure you click on there. It's probably going to end up most of the weekend be over here in our popular posts. Um, so check that out. Click on that link over here and check that out. And make sure your watch lists are up to date. Premium members, make sure they get access to a specific watch list. So make sure you're up to date with those over here. But let's take a look at how the sectors are doing, and you can see again everything went down today, and I'll update my sector correlations chart as well over the weekend, but all these correlations are strong. The only difference is all these big declines on the top performing sectors are all still above their moving averages, slightly below on staples. All the rest of these are below and breaking through, the healthcare breaking through those lows, not quite the new 3-month lows where we got all these clusters over here in late May. So not quite there yet, but we're getting there on energy and financials, especially. Those two are the first ones that have clusters so far. Materials is breaking through its lows. Communication service kind of is breaking through its lows, and you can see all the rest of them pretty much threatening to break down below these levels of support, just like on the S&P, and work its way to the downside. You can see again pink charts, right? And these are all dark pink shading because they're all below 50. Industrials, healthcare, communication services, materials, energy, financials. Technology is just a smidgen away from being a dark pink shading once it falls below 50. And of course, these three, discretionary as well. Discretionary just has to turn it around. It was rising. It's probably going to fall back down. And they all have red lines, so that's your bearish combination. The only three that don't have that bearish combination have strong bullish posture still, and they're rising. Now, staples will have the yellow line because it's trading below its moving average now, even though it's still rising. And it will probably turn into light pink shading by then. Like I said, usually that can be a buying signal when you have yellow line and light pink shading. We'll see if that ends up being the case for that safety. The market's going to have to bounce for all of these to bounce too. It's just a matter of where and when it will bounce and how much, right? That's sector rotation. All right, so for our trade idea of the day, I wanted to take a look at Adobe. So again, in our live video, we've already put this trade on, but I want to break down what this looks like. And again, it also has the bearish combination, right? Falling moving average. It's got this little bit of and all of them kind of look like this a little bit. The S&P has kind of a triple top, triple bottom thing going. But this little descending triangle where we hit these levels around 282-ish multiple times, but every time it bounces to a lower high point. That's a descending triangle. It's a bearish continuation pattern. Considering we had a bearish move to start it, you would expect a bearish move to come out of it. Obviously, we have falling market sentiment. We have a red line or intermediate bearish intermediate posture here. If you take a look at the long-term chart, you can see, we're kind of trading within. You can't really. It's hard to tell. Let's see if I can't give it a little bit of room here to work with. There we go. So you can see how it's breaking below the 50, and it's trying to fill in that gap towards the 200-day moving average. Which remember, the S&P has closed below. So you can see how Adobe's got this kind of really big time, long-term divergence, right? The PPO here, after getting up to this, formed that divergence right there. This peak, the momentum fell off a cliff by the time we reached that peak, and of course that was when the whole market pulled down. Well, this high is not anywhere close on the PPO, and so that would be a tremendous divergence to the downside. Even just a move to zero would be a pretty good move. There's a lot of opportunity, and if you look at the Bollinger Bands, you can see where we could fall down, you've got some support down to about 260 is your next major level. If you break into the value area, it won't get there in a day. There's some good volume here, but there's nothing really stopping it until it gets down to 260, and then after that down a little bit above 240 would be your next layer if we were to break into the lower half of the value area, or the lower, below the point of control. on the value. So still riding the bearish half of the bandwidth to the downside. If you take a look at the DMI, not surprisingly, you have the negative line falling below 20 already. You have the positive line actually already almost up above 25. Now get up to kind of this 30, 35 areas where it needs to be for it to sustain itself. This, like a move to the upside, would need to be sustained with a good move up above 30, 35. But you already have the beginnings of a bearish pattern developing on the DMI as well. Of course, when you look at the 3 green arrows for Adobe, and you'll see you've got we never did close above the 17-day. It's been riding the 17-day down, and now we're breaking back below. The MACD and stochastics both turning down. 3 red arrows on the chart on most of the MACD about to cross below. And we'll see if that ends up turning to be a selling opportunity, kind of a phantom red arrow there on the MACD. So what we can do, again, considering that if the market holds this low point and bounces, then I don't want to have a big loss in a position like this. I'm going to keep my risk small, but if we break and the floor falls through, I want to get a good reward. Remember, 260 is where we can get down to. So if I were to come out here to the October, give myself a little bit more time and just buy an out of the money option, buy this 270 option. That's below 40 in the Delta, right about mid 30s. I can pay $950, get a decent return on this if we were to continue down towards 260. I can cut that price down by selling getting 770 out of that one. Now instead of paying $950, I'm only paying $1.53. Again, assuming we get down to 260, that would be a maximum gain for this and would set me up for about a $350 reward for this $150 worth of risk. As you can see, if I were to analyze this and then go to just single symbol, there would be my reward for my risk. And if we bounce and I cut my risk in half and just get out if it bounces up halfway, see, it takes a long time to get the other half of a loss. So it'd really have to get to jump up tremendously to get to a maximum loss on this vertical spread. But if it didn't, it made a good bounce, take off half that loss. Now I've got a good 6-to-1 reward, almost a 6-to-1 reward to risk ratio if we were to break down to the downside, knowing that I can put position size around this, and there is earnings coming up, so we have to position size around that before October expiration. There is earnings coming up there. But again, so that's why you want to make sure that if we do get maximum loss, you don't want to take a full normal loss on that. So cut your position size down some, more than what you do normally. And then if you can get out with half the loss, if we bounce here early, then we'll just take that. Knowing that if the market bounces, and this bounces along with it, then you probably have a lot more bullish trades that are going to make you a lot more money than what you would lose on this hedge. Whereas the gains to the downside for the $70, 70 some odd, $75 of risk, the $350 of reward can go a long way towards helping soften the blow if the floor does fall through. Similar to what we did with Cisco, similar to what we did with First Solar, this would be another similar event, similar type trade. All right, well, that does it for today. As always, I appreciate you watching today. You've heard from me. You got my take. Now I want you to keep the conversation going. So use that link right there in the top right corner of your screen. It goes to our Market Outlook forums. Open up any new thread. What do you want to talk about in relation to what we covered today in the video, or maybe something we didn't cover and that pertains to this discussion? What do you want to talk about? Open up a new thread. Comment on other people's threads, and let's keep this conversation going. As always, thank you very much for watching our video. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment down below. And then follow me on Twitter for more content in addition to these videos. And then join our community at marketscholars.com, as well as the community we created on Facebook. Have a great weekend, everybody, and we'll see you all Monday.